Hey everyone, welcome to Predicting Net Income. So in this case, we've been given some historical data about Walmart, given their income statement or abbreviated income statement, and we're going to be determining in the future, 2015, what their projected net income will be. And the method we'll be using is the compounded growth rate method. And hopefully recall that from the previous chapter. And if not, that's fine. We have our formula here. Okay, so this will, I'm sure you'll be reminded of that. So we'll keep that with us and we'll discuss it in just a moment. Now in this case, we're actually going to be determining the growth rates for sales, our revenue, our cost of goods sold, selling and general and administrative expenses, and even our interest expense. Once we determine the growth rates, we'll use those to determine those actual dollar amounts for 2015 or predict, and then the rest will just be using our basic income statement math. So let's talk about this formula in a sec, right now. So reminder, again, when we talk about the ending divided by the beginning, the ending is the ending value, right? So in this case, our ending values is 2014. Typically, it would be considered your most recent data in case if we're actually projecting the next year. The beginning value is going to be sort of the most historical data that we have, where we can use to base our our averages. So in this case, our beginning data will be 2012. Now the N is simply the number of years between those two periods. Okay, so in this case, our number of years is 2 years. And it's also been rearranged here. So this is the official growth rate, but you can rearrange it to sort of the nth root of ending divided by beginning minus 1. So in this case, because the number of years is 2, so we can just sort of write that down so we remember, if the number of years is 2, then this is really just the square root of the ending divided by the beginning. Okay, and since we're using Excel, we can that helps us a little bit as well. So let's start with figuring out the sales growth rate, and we can do that by getting ourselves a little bit organized here. So if we have our growth rates down here, we'll start with sales. Okay, we can just take this down, and again, we'll just punch in our formula. Now we are using Excel, so we can use the square root function. And it's just going to be, again, our ending, okay, so the ending, our most recent sales, divided our least recent sales. And that's the square root. So again, if we're looking at the second formula here, we've completed this. Now we just have to subtract 1, and that should give us our growth rate. Just keep in mind, again, remember it is a percent, and we need to round to 3 decimal places. So we'll go ahead and punch that in. Okay, looks like that worked well. Now let's move on. So now we're going to just really apply the formula to now our cost of goods sales. So again, same idea. We have a cost of goods sold, okay? And in this case, we take now these are negative amounts, but still our ending divided by our beginning, and we take the square root of those two numbers and subtract 1. So if we do that and we use Excel, we can see again, same idea. Okay, so we're dividing the two, taking the square root and subtracting 1. So you can imagine we can just bring this all the way down. Now, I'm just bringing these down, but remember, look at the question. We're only going to be using cost of goods sold, sales, selling, so we don't need to worry about taxes or net income. Interest expense we do. Okay, so these are basically the sales growth rates, or the growth rates that we're concerned with. All right, so now that my computer stopped thinking for a moment, I can punch in my numbers. this is a great way to sort of predict. It's a very quantifiable way to evaluate future performance. And we'll probably be seeing this a little bit later when you're looking at your hotels. Interesting. So interest expense. Okay, wonderful. So now we can actually apply these percentages, right, to our future predicted year, or our future predictions in an amount form. So now we can actually determine what is our total sales for next year. So again, remember, we're just going to take our previous year, and we're ultimately going to add that 3.281% that we predicted. So in other words, it's going to be 1 plus the sales growth rate. Okay. So we can punch that in. Almost caught myself. So it says round to the nearest dollar. So let's make sure we do that. Okay, wonderful. Whew, that was close. And now we can again do the same thing. I'll just bring it down. I'm going to bring it down, and I'm going to delete a few things, and I'll explain why in just a second. Okay, now the reason why I'm deleting these is because these predictions are based off of the sales growth rates, but we're only using the sales growth rate. We're only using the growth rate, for sales, cost of goods sold, selling, and interest rates. So the other predictions are going to be based off of just simply using our balance sheet or our income statement and doing the math. Okay. So let's move on to our projected cost of goods sold. Remember, it is a negative number, so we need to make sure that we input that. And we have about 370. And these are all millions, but again, this is assumed throughout. Okay. Our next sort of projection. Yep, 94,693 million. Okay, and our interest expense. Again, don't forget the negative, as I seem to almost be. Okay, so now they just basically want us to complete the income statement. So we can, let's do it here first. So again, this is why we're not using the growth rates to determine the other few accounts. So our earnings before interest and tax, well, we have our total sales, and we're basically going to remove our expenses. Now for our taxes, we actually have to make sure that we take our earnings and we remove our expenses. Okay. So what I'm going to do is, and just make clear, this is not our taxes. This is our taxable income. Okay, and for some reason they don't. This is abbreviated, so they don't include it. So then we're going to take, and in this case, they give us a tax rate of 37%. Okay, so we're going to multiply that by 37% to get our taxes. Okay, and again, just remember it is a negative because we are paying taxes, so that's important to note. And finally, our net income now can simply be removing our interest expense and our taxes. Okay, so there you have our total projections, if you will. So we just punch that in. Just remember, be mindful of the negative. Okay, so our expenses are going to be negative. Make sure you don't punch in the wrong numbers. It's good advice. Okay, this is positive. And our interest our taxes. One thing to keep in mind, good reminder for me, again, make sure that we are rounding, but it should be okay, it's still okay. And then finally our net income, which is hopefully positive. Okay. There we go. So we've predicted net income using the growth rate method. Thanks for watching and happy financing.